Hey friends, welcome to today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. Singapore Airlines, our national carrier, has just released its February operating update, and the numbers tell an interesting story. SIA and its low-cost arm Scoot posted a modest 0.5% year-on-year increase in passenger traffic for February. This slight growth comes as travel demand naturally tapered off following the end of the Chinese New Year festive season. Looking deeper into the numbers, we see a bit of a mixed bag. The parent airline, Singapore Airlines itself, actually performed quite well with a 3.6% increase in passenger traffic compared to the same month last year. However, Scoot wasn't flying as high, recording a 9.3% drop in passenger traffic, which dragged down the overall group performance. For those tracking SIA's stock performance, shares climbed 0.06 or 0.9% to close at 675 on Monday. This modest gain suggests investors remain cautiously optimistic about the airline's prospects despite the seasonal slowdown. For context, Singapore Airlines operates in a highly competitive industry where seasonal fluctuations are normal. The post-Chinese New Year period typically sees reduced travel across Asia as families return home and settle back into work routines. What's encouraging here is that despite this seasonal dip in Scoot's underperformance, the overall group still managed to post positive growth. Looking at the technical picture, SIA stock has been showing resilience in recent months. The current price of 675 puts it in a relatively stable position, though still below its pandemic recovery highs. Trading volumes have been steady, suggesting no major shifts in investor sentiment. ST Engineering has just made an announcement that should catch the attention of income-focused investors. The company plans to increase its total dividend to 0.18 per share for FY 2025, up from the 0.17 per share proposed for the current financial year. This represents a modest but welcome increase for shareholders looking for steady income. Even more interesting is ST Engineering's new dividend policy starting in FY 2026. The company plans to pay out about one-third of its year-on-year increase in net profit as incremental dividends. This progressive dividend policy ties shareholder returns directly to the company's financial performance, creating a clear incentive for management to drive profit growth. Investors responded positively to this news, with shares of ST Engineering ending Monday 1.8% or 0.11 higher at 632. This price movement suggests the market views the dividend announcement as a sign of management's confidence in the company's future earnings potential. For those not familiar with ST Engineering, it's a global technology, defense, and engineering group with diverse operations spanning aerospace, smart city, defense, and public security sectors. The company has a strong track record of securing major contracts across its business segments, providing a relatively stable revenue base. The current share price of 632 puts ST Engineering at a reasonable valuation compared to its historical ranges. The stock has been trading in a relatively tight band over recent months, with this dividend announcement potentially providing upward momentum. From a technical perspective, ST Engineering stock has been showing a gradual uptrend since the beginning of the year. The increased dividend could serve as a catalyst for further gains if the broader market remains supportive. Trading volumes have been average, suggesting steady rather than speculative interest in the stock. There's a leadership change coming at CapitaLand Integrated Commercial Trust, one of Singapore's largest REITs. The manager announced that current Deputy Chief Executive Tan Choon Siang will be stepping up to become Chief Executive and Executive Non-Independent Director starting May 1st. He'll also join the executive committee as part of this transition. Tan will be taking over from current CEO Tony Tan, who isn't leaving the CapitaLand family but rather moving to a new role as Chief Corporate Officer of CapitaLand Development, also effective from May 1st. Leadership transitions always warrant attention from investors, as new management can bring fresh strategies or priorities. In this case, with Tan Choon Siang already serving as Deputy CEO, we might expect more continuity than dramatic change in CICT's approach. Units of CICT closed 0.5% or 0.01 lower at 2.12 on Monday, suggesting the market took this announcement in stride without major concerns. This muted reaction is typical when leadership changes involve internal promotions rather than bringing in outsiders. For those who might be new to CICT, it's Singapore's largest retail and commercial REIT with a portfolio of quality properties, including shopping malls and office buildings primarily in Singapore, with some assets in Australia. The trust was formed through the merger of CapitaLand Mall Trust and CapitaLand Commercial Trust, creating a diversified commercial REIT powerhouse. The current unit price of $2.12 places CICT at a modest discount to its book value. REITs like CICT have faced headwinds from rising interest rates, which increase borrowing costs and make their dividend yields relatively less attractive compared to fixed income investments. However, with expectations that interest rates may begin to moderate, REITs could see renewed investor interest. Sembcorp Industries. There's some intriguing corporate action potentially brewing at Sembcorp Industries. The company has responded to a Bloomberg report released on Monday, which suggested Sembcorp could be considering going private or selling assets as part of a strategic review of its business. In its response, Sembcorp acknowledged that it continually reviews its portfolio and may from time to time engage with external advisors to consider available options. This carefully worded statement neither confirms nor denies the specific possibilities mentioned in the Bloomberg report, leaving investors to read between the lines. The company added that it would make necessary announcements when there are material developments and warn shareholders to exercise caution when dealing with its shares. This type of cautionary language is standard when companies are potentially exploring significant corporate actions. Investors seem to view this news positively, with shares of Sembcorp ending Monday 2.4% or $0.14 higher at $6.10. This price movement suggests the market sees potential value in a restructuring, whether through privatization or asset sales. For those not familiar with Sembcorp Industries, it's a leading energy and urban development company that has been transforming its business in recent years to focus more on renewable energy while reducing its exposure to traditional carbon-intensive power generation. This strategic shift aligns with global energy transition trends, but requires significant capital investment. The current share price of $6.10 reflects a strong recovery from pandemic lows, though the stock has been somewhat range-bound in recent months. Trading volumes have been relatively normal, though we might see increased activity as investors position themselves based on speculation about potential corporate actions. From a technical perspective, Sembcorp's stock has been in an uptrend over the past year, supported by improved financial performance and its growing renewable energy portfolio. The current price sits near recent highs, suggesting investors remain optimistic about the company's prospects. First Resources is making a significant move to expand its palm oil operations. Its subsidiary PT Ciliandra Perkasa has entered a conditional agreement to acquire 3.1 billion shares, representing 91.2% of the issued and paid-up capital of PT Ostindo Nusantara Jaya, TBK, a publicly listed Indonesian company. The deal comes with a price tag of $329.8 million, marking a substantial investment for First Resources. The strategic rationale behind this acquisition is clear. First Resources hopes the proposed acquisition will help expand its upstream oil palm plantation footprint and enhance feedstock availability for its growing downstream operations. In simpler terms, they're securing more land for palm oil cultivation while also ensuring they have enough raw materials for their processing facilities. Shares of First Resources ended Monday 1.2% or $0.02 higher at 168, suggesting a modestly positive reaction from investors to this acquisition news. The relatively small price movement might reflect that while investors see the strategic value, they're also aware of the significant capital outlay involved. For those not familiar with First Resources, it's an integrated palm oil producer with operations primarily in Indonesia. The company manages plantations and processing facilities, producing crude palm oil and palm kernel oil, which are used in a wide range of consumer products from food to cosmetics. The current share price of 168 puts First Resources at a reasonable valuation compared to its peers in the palm oil sector. The stock has been relatively stable in recent months, trading in a narrow range as palm oil prices have moderated from their previous highs. That wraps up today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and I'll be back with more market insights in our next update. Thanks for tuning in, and happy investing!